10th of December 2015. My name is David Hickson, and as always, before we take a look at markets, please make sure that you have read and understood these disclaimers. Let's take a look at the markets, and I thought that I would start this week, just to break tradition, with a look at the euro-US dollar, because last week, following Mario Draghi's speech, or well, perhaps I shouldn't say speech, there's some interesting comments I'd quite like to make about the news. I do love banging on about the interaction between financial markets and the news, and how news tends to influence financial markets. So I'm going to sort of come back to that point. But as you can see in this chart, something very interesting happened to the euro last week on Thursday, I believe it was, and that is that, of course, the euro really suddenly bounced up. It bounced up, and I think the full range of that day was about 5 cents. It was an extraordinarily big range day. So I thought I would start this week's webinar by having a look at this analysis. And of course, it's an analysis that you should all be familiar with, because I've been looking at the euro US dollar over the past few months in these webinars, and I've been discussing what I believe has been happening. And here are the big points. If I can get this pen to work, here we go. The important of this analysis is that I believe there was a very long major cycle trough that occurred in March of this year. Now, that was a trough that I'd been anticipating for some time. I'd been looking forward to it, and I'd been expecting a really big magnitude trough to occur. And a big trough did occur in March, and fairly shortly after that date, it was the second week of March, if memory serves me correctly, fairly shortly after date, I started discussing that as a potential trough for the 54-month cycle. That's a 4.5-year cycle. And so, of course, we expect the markets to bounce up fairly strongly from a 54-month cycle trough. A very important aspect of Hurst cycles is that, of course, there are multiples that are all working together. And when a price bounces out of a 54-month cycle trough, that doesn't necessarily mean that it's going to just go straight upwards for 2.25 years, which is what you might assume when you first come across Hurst cycles. But it does certainly mean that the general movement of the price is likely to turn upwards. And so you can see we've since that time, which was almost 9 months ago, we've had a full 40-week cycle elapse. And here you can see this nest of lows. A nest of lows is simply a collection of where the next troughs of particular cycles are expected, and they tend to form that sort of triangle standing on its head shape at the foot of the chart. That's what Hurst called a nest of lows. Because of the principle of synchronicity, cycles, of course, have synchronized troughs, so the troughs occur at the same time, and when those troughs that are expected to occur at the same time line up like that at the foot of the chart, then we get a very neat nest of lows. I really enjoy an analysis when I can see a very neat nest of lows, because it tells me that all the cycles are working with a good deal of harmonicity and synchronicity together. In other words, they're beating with fairly accurate rhythms. Of course, cycles influence prices to move, and they suffer constant variation. The wavelengths of cycles are varying all the time. So you don't expect the markets to be a perfect example of what's happening with the cycles. But when you get a very neat nest of lows like that, it's an indication, in my opinion, of a good analysis. And so we were expecting a 4th cycle trough to occur, and I spoke about it last week, and in the webinar before that, which was about 3 weeks ago, I think, I spoke about this anticipated 40-week cycle trough. As you can see, last week on Thursday, price jumped up. Oh, I've sort of drawn over it. Let me just wipe that out. And here we go. On Thursday of last week, the euro US dollar suddenly bounced up, which is most probably the formation of the 40-week cycle trough occurring in the market. It's always that you see a trough forming that clearly. I mean, it was a surprise to see the euro bounce up so much in a single day. We were expecting the big move up, but for it to happen in a single day is an interesting occurrence, and it happened in conjunction or at the same time as the speech by Draghi, which was a news event which happened last week. So there's a very interesting interaction between news events and financial markets, and present. I'd like to speak a little bit about that and present my opinion, which is largely informed by what could be considered to be an official Hurst Cycles opinion or Hurst's opinion. Hurst the euro started to rally 1 hour before the speech, before the news event, which was, of course, the European Central Bank announcement. And yeah, so that's really interesting. It was clearly connected to that news event. Now, Hurst mentioned that cycles combine to influence price movements of financial markets. When you first mention that concept to many people who are not familiar with Hurst cycles or who are not particularly familiar with a technical analysis approach to financial markets, those people will often say, but surely news events move markets. In other words, markets turn around because of news events. And there's an interesting subtlety here. Hurst said that news events cause what he called fundamental interaction. Um, and basically what that means is that news events cause tremendous volatility, and they can often be the trigger for turns to happen in the market. However, those turns are turns that we expect because of what the cycles are doing. And last week was a really fantastic example of that, in my opinion. We had the ECB speech, and we were expecting, as Hurst analysts, we were expecting the markets to turn because we're expecting a 40-week cycle trough. Often the markets need some kind of a trigger, and news events very often provide that trigger. So when you're waiting for a big event, such as a 40-week cycle trough to occur, it's a very good idea to look out for news events happening around about that time, because those news events will often provide those triggers. In fact, in last week's webinar, if you take a look at last week's webinar, I was speaking with Sid Norris of Elliott Wave Predictions, and we were speaking about the euro, and he mentioned the upcoming speech or announcement, and mentioned that we should probably wait until that happened before before we would expect anything to really happen in the euro. And that is very often what does happen, is that markets go very quiet prior to some kind of a news event. And then the news event either provides tremendous volatility without any really sort of meaningful change in direction, or the news event ends up providing the trigger for the change in direction, which is what I believe happened here in the case of the euro. Filippo says it's manipulation. Yes, perhaps so. Manipulation is an interesting thing. Many people discuss manipulation of the markets, and manipulation of the markets has become a very, very big issue. Markets these days are, there's no doubt about it, they are manipulated tremendously by the people who trade them, and by the big banks, and by politics, and all that kind of thing. But to some extent, I tend to take a slightly different stance on it, and this is my personal opinion. It's not necessarily an official Hurst Cycles opinion. My personal opinion is that in many ways markets always have been manipulated, and the price movements are really simply a graphing of what happens to price, whether it's being manipulated or not. So yes, manipulation will tend to distort things, and certainly manipulation of markets will tend to cause these really strong moves, such as we saw last week. The market was potentially being sort of held down in anticipation of the news event, and then it jumped up again. So yes, perhaps it's a manifestation of manipulation. To some extent, I think that manipulation of markets is an integral part of markets. I think it's a huge aspect of the way that markets have functioned over the years. Perhaps manipulation has become a good deal more complex. Whether that means it's evil, I don't want to use the word evil, whether that's a negative manipulation, I don't know. I see someone mentioned, I can't see the name, it's covered by that block, the plunge protection team. Oh, I see. That's a question. Am I saying that the plunge protection team is ultimately powerless? That's a really interesting question. I think that I don't think the plunge protection team is powerless. No, I think they're very powerful in terms of the way in which they are able to prevent plunges, big panics, and that kind of thing. But ultimately, yes, I suppose I am saying they're powerless, because if markets are going to go down because of the cycles that are influencing those markets, then no manipulation, in my opinion, and this is my opinion, I could, it could be entirely wrong. It's not necessarily a Hurst cycles opinion, but in my opinion, ultimately, any manipulation is fairly powerless. What will tend to happen, in my opinion, with manipulation is that you will tend to see price getting sort of squeezed, and the cycles. You can see it, and we'll look at it in some of the other markets today. The cycles aren't really able to show themselves because the markets aren't moving in a natural way, and so therefore bodies like the plunge protection team are clearly not powerless, because they are exerting a good deal of power, and they're preventing the cycles from showing themselves in markets and making our lives a lot more complicated, because it makes it more difficult to see those cycles. But ultimately, I do believe that the cycles will show themselves, and price will turn around. So potentially what happened in the euro US dollar last week was an example of that. Yes, we've been expecting the turn, and the cycles seem to indicate that that turn, was due last week. I mean, you can see this is a very neat nest of lows. Oops, not a very neat drawing. That's a very neat nest of lows there. So we were really expecting that turn, and eventually, of course, the turn did come. If a market has been manipulated as a matter of interest, you will often see turns in the market occurring a little bit like corks popping out of champagne bottles. They will happen really, really fast, and that is often an indication that the market has undergone some form of manipulation. As a matter of interest, a very brief aside, I used to really struggle with the euro to Swiss franc. I found it impossible to trade the euro to Swiss franc profitably using intraday cycles. I was working with intraday cycles. Euro to Swiss franc just proved to be really, really tricky. And as a matter of interest, I believe that was probably because of the Swiss bank, Swiss National Bank, fixing the rate between the Swiss franc and the euro, which is ultimately a form of manipulation, which made trading cycles really quite complicated and not very good. I see Philippe saying, as an Elliotician, he's expecting the turn in the euro. Yes, indeed. And last week, Sid Norris mentioned the Elliott wave perspective. Last week's webinar was very popular. We're going to be introducing much more Elliott wave analysis in conjunction with Hurst analysis, I hope, in these webinars in the future. It's a very, very powerful combination. Okay, so that's what happened in the euro last week. It was something we were expecting, of course. And as you become familiar, I know that many of the people on today's webinar are, in fact, very experienced Hurst analysts. This is no surprise to you. But you'll find, as a Hurst analyst, very, very often come at times that, of course, we are expecting them. And Heijin Lee, I don't know if I'm pronouncing it correctly, says the news always arrives to justify the forecast. Yes, exactly. Many people believe that the news moves markets, not because we're born believing that, but because that's what the media lead us to believe. What happens, in my opinion, and I have quite a strong media background. I'm a television director, and I've worked for many years in multi-camera television. I'm fairly familiar with the media and the concept of the media. I directed many of the live eviction shows for Big Brother. Those big shows when the finalist leaves the house, or no, somebody else leaves the house. So I'm very familiar with the concept of media, and in my opinion, what happens with the media is that they need to keep the public happy by telling the public a story. And when it comes to financial markets, what the public wants to do, of course, is to understand those financial markets. And so the media obliges by providing reasoning. And so our very strongly held belief, not our belief, but the strongly held belief of many people with regard to the interaction between news and financial markets, is caused by the fact that the media, trying to keep us happy by telling us a story and explaining what has happened, will always provide some kind of reason for a move. It's a very interesting thing to do. Pick any financial headline, and you will always see there's a cause and an effect. And the effect is, of course, the movement of the market, and the cause is always some kind of a news event. I've learned that the best thing to do is to read the effect. So read about what happens, but completely ignore the cause, because in my opinion, the cause is usually wrong. But of course, a news event can provide a trigger. And Robin suggests that news items release stored energy. That's a very interesting concept. Let's take a look here at an interesting thing. When a market jumps very strongly, or not even when it jumps suddenly, but when a market is moving, which of course markets are doing all the time, I always look at FLDs, future lines of demarcation, to see why a market might reach a particular level and where it might go to. So we've got a few very interesting FLDs here. I'm going to make this chart look a little bit messy for a moment as I display these FLDs. In fact, let's just do them one at a time. And in fact, let's start with the 20-day FLD. In last week's webinar, was it last week? I think it was last week's webinar, I mentioned that my favorite FLD, the 20-day FLD, was very close to price. And so you should be careful about entering into this trade at the level of the 20-day FLD. Now, most of you know, I think, trading strategy, which trades the interaction between price and the FLD. It's a very simple strategy, and basically you enter into a trade when price crosses the FLD. I mentioned last week that the 20-day FLD was very close to price, and so therefore you should be a little careful, perhaps cautious about entering at the level of the FLD. I would just like to show you some detail, because in these webinars I often don't get to really go into some detail, and I think perhaps that is due today. Let me show you what happened last week, because even though the 20-day FLD was potentially too close level to enter into this market, it nevertheless forms a very important level, and I'd like to demonstrate that to you. Can you see here how we did our webinar on the Monday, of course. So here is Monday. There we go. There's Monday. And the FLD was over here. On Tuesday, and of course the big move was on Thursday, so this is still some time in advance of the big move. On Tuesday, price came right up to the FLD. The FLD is, of course, this purple line. Can you see? I don't know, I hope that's big enough on your screens. Perhaps I can zoom in a little more. Let me try and zoom in just a little more. And there we go. Okay, so on Tuesday, price came right up almost to the level of the FLD. I hope you can see that. And on the Wednesday, the FLD was below the high of Tuesday. Okay, so the way that the FLD strategy works is that you would trade on the basis of price crossing the FLD, but you never make an entry if the FLD is within the range of the previous day. So that's in itself, in my opinion, a really interesting interaction. The 20-day FLD, not just the 20-day FLD, all FLDs are really important levels for the market. And so it wasn't unusual to see price come right up to the level of that FLD. You can see on Wednesday, it actually bounced back down again from that level. Okay, when price does that, it indicates that that it is respecting the level of the FLD. It doesn't mean it's not going to cross it, but if you were following the principles of the FLD trading strategy, then you would not have entered on the Wednesday. You might have been interested at entering at a level of Tuesday's high, but on Thursday, the 20-day FLD came up to a higher level. I don't know if you can see that. It was that level over there. So even though it was very close to price, it did provide us with some kind of an entry level. Excuse me, I've got a bit of a bit of a cough today. That interaction was very interesting and very useful. Sometimes, because we're speaking about the bigger picture in these webinars, sometimes I tend to gloss over the details, but the details are, in my opinion, really very important. So I was watching that 20-day FLD last week, and I could see price coming up to the FLD on the Tuesday, bounce back away from it on the Wednesday, and on the Thursday the FLD level was a bit higher, but it was providing an important level. Of course, on Thursday we had tremendous volatility, and so and that was when the FLD finally got penetrated. But it's useful to also look at some of the other FLDs, and so if we take a look at the 40-day FLD. Now, when the 20-day FLD is too tight, too close to price, you ask yourself, where else could I consider getting into this market? And in last week's webinar, some people suggested VTLs, which are, of course, also providing very interesting levels. But I tend to look at the next longer FLD, which in this case is the 40-day FLD. And here you can see the 40-day FLD. And now what does it mean when price crosses up above the 40-day FLD? That a trough of at least 40-day magnitude has formed in the markets. If a trough of at least 40-day magnitude happened at this point in the markets, and let's just zoom out again, if it was at least a 40-day cycle trough, then in my opinion, that meant that it had to be at least the trough we were expecting of 40 weeks in magnitude. I see Filippo is saying, so now that price is above the FLD, are you expecting a 40-day rise? No, Filippo, we're definitely not expecting a 40-day rise. When price crosses a particular FLD, it gives us confirmation that price is bouncing off a trough of that particular cycle. Okay, when price bounces out of a particular cycle trough, it doesn't mean we're going to get a 40-day rise by any means. It simply tells us that the trough that is formed in price is of a particular magnitude. In this case, when price crossed the 40-day FLD, which provided a good entry level into this trade, that's right, a cycle is completed. And in this case, it's telling us that the cycle that was completed was a 40-day cycle. Okay, and so there are our 40-day cycles in circles at the foot of the chart. And so when that 40-day cycle completed and formed a trough, it also, because of the principle of synchronicity, had to be a trough of the day cycle and the 20-week and the 40-week. So we can use the 40-day cycle FLD as a tighter entry level for confirmation that the 40-week cycle trough has formed. You'll find when you're working with Hurst cycles, you're constantly doing this. You're working out what's your level of confidence. If I take the FLD off the screen for a moment, as price came into this trough over here, if it started moving up, and in fact, let me just sort of zoom in here a little bit. Let's take one of these troughs over here, this one or this one. As price bounced out of each one of those troughs, we were expecting a 40-week cycle trough to form. However, we had to ask ourselves, what's our level of confidence? So for this first trough over here, what was our level of confidence? Well, we had an 80-day cycle trough over here, and I can count those bars. At that point, it had been only 48 bars since the 80-day cycle trough. What's our level of confidence that this is the 40-week cycle trough? It's actually very low. So therefore, you don't use a tight or lower level FLD. When we stepped forward a little bit, 56 days since the previous 80-day cycle trough, again, what is our level of confidence? At 56 days, we are actually expecting another 12 days to elapse. 40-week cycle trough is expected. So our level of confidence is not that much higher. At this point, with another 12 days to go, this would probably only be a bounce out of a 20 days cycle trough, which, as you can see, the foot of the chart, is what the software has decided it was. At this point, on Thursday, or perhaps on Wednesday, the day before, you would ask yourself the same question: how many days have passed? How many days have passed since the previous 80-day cycle trough? In this case, it is 70. Our average wavelength of an 80-day cycle is 68. So at this point, our 40-week trough is 2 days overdue. So our level of confidence increases. When your level of confidence increases, you can use a shorter FLD to provide you with evidence that that particular trough has occurred. Now, I started this discussion because I wanted to show you where. Sorry, let me just sort of go through this again. Let me turn that FLD back on again. We looked at the 20-day FLD, provided a very tight, but probably a little too tight entry level. The 40-day FLD provided a very good tight entry level, not tight, but fairly close. Let me just take a sip of water so that I can clear my throat. Just give me a moment. Okay, that's better. So the 40-day cycle FLD over here gave us a good entry level into this move. If you'd caught it, it was a very quick move on Thursday. And you can see the 40-day cycle projection has in fact already been achieved. That would have been over there. That would have been our target for the move. And but now let's take a look at some of the other FLDs and ask ourselves what those FLDs mean. Let's take a look at the next longer FLD. There is the 80-day FLD. And isn't that interesting? Do you see how price bounced all the way up to the 80-day FLD? So the high of the move last week, Thursday, was in fact the 80-day FLD. These FLDs, all of them, are really very important levels of the market. And I say it time and time again, if you're looking for where the market is, take a look at the FLDs, because they will very often provide very important levels for the market. So price moved up to the level of the 80-day FLD on Thursday. But now, if that was a trough of the 40-week cycle, when can we be confident that that is definitely a trough of the 40-week cycle? And here's the last comment that I would like to make about the FLDs. And that is that, of course, we know that a 40-week cycle trough has formed in the market when the 40-week cycle FLD is crossed. If you're using FLDs to confirm your cycle phasing, then when the 40-week cycle FLD is crossed, that is when the 40-week cycle trough is confirmed occurred. There is the 40-week cycle FLD, and you can see it comes down this week. And so with not very much effort, if it just pops up over here and stays up above this level, it will have crossed above the 40-week cycle FLD, providing us confirmation that the 40-week cycle trough has formed in the euro. Okay. So if you have any other questions about the euro, now's really a good time to answer them. The 20-week FLD and the 40-week FLD, is there a problem with that? That's a really interesting question, Rob. And it's something that people often ask. And you know, in a perfect market, if the markets worked absolutely perfectly without any sort of random noise or market manipulation or anything like that, see our FLDs always being in perfect order, if you know what I mean. So it would go from 20-day, 40-day, 80-day, 20-week, and then 40-week. Here you can see a bit of an anomaly. This FLD here, the highlighted one, is the 20-week FLD, which is up above the 40-week FLD. People often ask whether that's a problem, whether it invalidates the whole FLD thing. There's no doubt that it is a bit of a problem, because it is not an ideal situation, but it is something that you will often see. It doesn't necessarily invalidate the whole FLD argument, but it does tell us that there has been something happening in this market that isn't cycle perfect, if you understand what I'm saying. So you know, something's been happening which has displaced the 20-week cycle FLD a little bit, and we get these FLDs going out of sequence. In my opinion, it doesn't invalidate what's happening with the other FLDs. It's just an example of how the markets aren't perfect, and sometimes you get these FLDs out of position. So I hope that answers your question. Is it a problem? I don't think it's I don't think it's a serious problem, but yes, it's probably something that you need to just be aware of. Let's just zoom out a little bit and see. Let me hide this 80-day FLD. Here we go. Now, of course, when you get a peak in the FLD, you expect to find a trough in the market. So let me just, here's a peak in the 20-week, and here's another peak in the 20-week, which would mean that we would expect a trough in the 20-week to be either here or here. Yes, Robin, as you're saying, it could mean that this low is not the low. It could absolutely mean that if the 20-week FLD is providing us with more accurate information than the other FLDs. I'm not sure that we can say with any certainty that the 20-week FLD is providing us with better information. Hurst cycles analysis and making trading decisions is always a matter of taking all the evidence, looking at what evidence we have, and sizing it up. It's very rare that you get completely non-contradictory information with everything lining up perfectly. There often will be something a little bit contradictory in there, and in this case the 20-week FLD is that piece of contradictory evidence. But I've shown you the two high points in the 20-week FLD, and what you'll find often happening, particularly when using FLDs to identify the position of future troughs and peaks, what you'll often find happening is that you get a bit of a, I call it a cycle inversion, but I think that's the wrong term, where you get a peak in the FLD, that's one peak there, and you get another peak over there, and you get a dip in between. Now, this is just something I've observed, but I call it a cycle inversion. It might not be the right term, but what often happens, and it has to do with the M shape of cycles, in my opinion. You get an M shape of a cycle And of course, the actual peak of that cycle occurs, of the inverted part. So if we invert that central, then that is the actual peak. And so in the 20 FLD, we're seeing something like that. I hope you can see what I'm saying. You've got a peak in the FLD here and a peak in the FLD here. What I found often happens, the actual trough in price occurs right in the middle, which is exactly what's happening there. So, so I think that is not necessarily something to really say, well, this is definitely not the trough. But yes, it is something to bear in mind. Perhaps that trough still lies ahead of us. David has to leave early. Thank you very much, David. Best wishes to you as well. So I hope that answers. It doesn't really answer your question, but yes, possibly it does mean that the trough has not occurred, which is why I bring up this 40 FLD. When price crosses above the 40-week FLD, and of course it needs to cross it and stay above it. It's not good enough if price simply crosses above it this week and then drops down. Getting above the 40-week FLD and staying above it. That's the really important point. So we had an important trough forming over here at exactly the time that we expected the 40-week cycle trough to occur. It is probably a trough of the 40-week cycle. And at this point, we're entering trades on the assumption that that is the trough of the 40-week cycle. However, we can only confirm for ourselves, we can only be convinced that this is a trough of the 40-week cycle when price crosses up above that 40-week FLD. And that's really the point that I wanted to make, is that it isn't confirmed yet. We see more volatility. Well, we might, but in my opinion, I think it's likely that the 40-week cycle trough has occurred. But I'm not going to bet bank on that until, of course, price does get up above the 40-week FLD. But in the meantime, certainly, there's profit to be made from entering into long trades. Well, not now, but there was profit to be made from entering into long trades. I hope that answers that about the euro. I'd like to quickly take a look at gold, because something interesting happened in gold as well. Where are we here? Something interesting happened in gold as well last week. Not on Thursday, Friday, we had a very strong move up. And now this is the analysis that we had John discussing, about 2 months ago, using a short-term nominal model. So we're looking at a 42-month cycle and a 14-month cycle instead of 15 to 18 months. Let's take another quick sip of water. I see Filippo is saying from an Elliott wave perspective, the confirmation of the bottom, that's back on the euro, the confirmation of the trough is when if priced above 110.85. Okay, well that's really quite interesting. Turn on this pen. 110.85 is this level here. So in other words, price needs to stay up above that level, which isn't above at the moment. Well, a few hours ago when I loaded the data for this chart. Okay, so that's an interesting point. Let's take a look at gold. And I mentioned this is the analysis that John presented 2 months ago, I think it was, where we are expecting a really big, very important trough for gold, a trough of potentially 7-year magnitude, potentially. And so we've been looking ahead to that. When we first discussed this analysis, I think it was right at the beginning of October. So we were back here when we first discussed this analysis, and we were saying that we should be expecting a really big magnitude trough. The important thing is when you're expecting a really big magnitude trough, the important thing is not to jump in too quickly, because the markets can always surprise you, but you need to look at the evidence carefully. There's John. Hi, John. you still think gold and the euro US dollar should be in sync. That's right. You mentioned back in that webinar that the euro US dollar and gold should be in sync, and indeed they seem to be now in clear analysis. And let me just zoom out a little bit so we can take a look at it. Let me just go all the way out and show weekly, monthly, put on those cycles. Here we go. So this orange cycle, 42-month cycle, I don't have a lot of data loaded up here. You can see that here's the nest of lows on the monthly chart. It doesn't show us a great amount of detail. Let me change that to weekly and zoom in a little bit and pin off. There we go. So here you can see price coming down. It's come down in 3 14-month cycle jumps. The yellow cycle here are 14 months, and so here's the first 14-month cycle, then the second 14-month cycle, and now we're watching it come down into the third 14-month cycle, and you can see that with this analysis, and this is the default analysis, I believe. I don't think I've done anything to change it particularly. You can see, according to this analysis, let me just clear the semicircles to get a bit messy at that detail. You can see that we had, here we go, we had this trough here, the end of July was probably a trough of that, what we would call the 40-week cycle. It's a slightly shorter cycle with this nominal model. And this trough over here is then when we were expecting the 20-week cycle trough. So we have an interesting situation in gold as well, not solely as we are expecting gold and the euro US dollar to move with a great deal in common. But let's just have a look at something interesting here. John mentioned the important thing to look at. Well, first of all, before we look at that, let me just point out again a nice, neat nest of lows. Here's the nest of lows. We were expecting this 20-week cycle trough to form. It's slightly shorter with this nominal model. I think it's about 15 weeks. So we were expecting a 15-week cycle trough to form around about this time. The market obliged, and of course we can look at our FLDs and see what the FLDs are telling us. There we go. And okay. The important FLD to take a look at is the 30-week FLD, which John mentioned in that webinar 2 months ago. He mentioned that the 30-week FLD would need to be crossed by price to the upside before we could even begin to think that the really long cycle trough had formed. Okay, so just in case you're thinking that maybe the trough that formed last week on Thursday was not a trough of 20-week magnitude, as indicated by this nest of lows, perhaps the really big long trough that we've been expecting, we would need price to cross up above this 30-week FLD, which is this line that I've now scribbled all over. We need price to cross up above that before we could even begin to think that. Interesting to see here again how price has come up to the FLD on Friday. It didn't quite reach it, but it came up close to it, and so far it has remained below it. So that's definitely an important line to watch, that 30-week FLD. Let's move along. If you have any questions or anything to say about gold, then please do so. And as John points out, with the 30-week FLD, that's an issue. There's a very interesting thing, and that is that, of course, when price crosses an FLD which is moving downwards, if price had crossed that FLD point, we would get a nice clean cross. However, with the FLD rising upwards, is likely to be very messy, because even if price bounces up above the FLD one day, the next day the FLD catches up with it and price ends up being below it again without having done anything. So you need to be a little careful of times like this when the FLD is rising, because for price to cross above the FLD during this period, which is through the rest of December, for price to rise above the rising FLD is very difficult, and you need to be careful. You certainly wouldn't be entering stop entry levels, for instance, at the level of your rising FLD, because price might rise above the FLD and then the next day, without doing anything, end up below it again. You need to be careful of that. Sid, can I zoom out? Yes, let me zoom out. Have a look at 30-week FLDs, FLD dips. Let me zoom out. Here we go. Okay. And 30-week FLD has been an interesting one, as you can see. Sid would like to see the future. I'd like to see the future as well. I think we all would. I'm not sure what you mean by that. Robin says FLD shadowing means the next longer cycle is guarded. Yes, indeed. That's a really long conversation. But yes, it's something that I've observed and I work with often. When the FLD, when price shadows the FLD and moves along, it tracks a lot in the formation of a peak generally. Then that's an indication the next longer cycle is dominant, which in this case would be the 14-month cycle. So it would seem to indicate we might have a 14-month dominant cycle. That's probably going to have to be a subject for a separate webinar. I wanted to see when price was more likely to cross the 30-week FLD. Oh, I see what you're saying. So okay, sorry. Yes, do see what you're saying. So that's really what you wanted to see there, I think, because we have a rising FLD here, but of course, the most suitable time, or not the most suitable time, but the most meaningful time for price to cross the FLD would be when the FLD is moving down like this. So from the beginning of February, it looks like it's lining up a really interesting opportunity, a really interesting time from the beginning of February until, of course, this nest of lows, which is very staggered, but it's at the bottom of the chart over here. So we're looking at March or April for that trough potentially. And John, I would bet on the important low with the next week cycle. Okay, so the next 15-week cycle. So the next 15-week cycle, and the 15-week is this dark blue color. So the next 15-week cycle is when we should be looking at possibly the really long, the big magnitude, 7-year cycle trough to form in gold. So we can do a bit of measuring here, and so let's see, 15 weeks would be round about here, March, April sometime. Okay, so March or April sometime is going to be a very interesting time to look out for another trough forming in gold. The advantage of Hurst cycles is that the troughs will keep occurring with regularity at the times of these cycles. And so in 15 weeks, we should see the formation of another 15-week cycle trough. And potentially, as John is saying, that looks as if though it be the trough of the really big magnitude cycle, the 7-year cycle. So that's something to look for in gold. So this analysis looks really good. Yes, well, thanks, John. It's your analysis. I took your nominal model. Okay. So it's asking if John has applied the model to ASA. Okay, he hasn't. Perhaps that's something we should look at doing. As a matter of interest, while we're on gold, somebody asked me some time ago to apply the short and nominal model to GDX, the ETF for the gold index, the gold miners index, the gold miners index ETF, I believe it is, if I've said that correctly. And here it is. Now, I haven't messed with this analysis, as you can see. And this analysis is positioning the really long cycle trough here in September. It looks to me as if this analysis is beginning to drift off track a little bit, and not really quite as good as our pure gold analysis that we were looking at. But there is something interesting to look at here. Oh, and John points out that gold is expected to bottom after this. That's very interesting. So perhaps the gold miners have formed their trough. Certainly what this analysis seems to indicate. Let's pop up the composite model line, which, as you know, is a line that we're still testing, and we'll look. The composite model line for this analysis shows something interesting, and I don't want to spend too much time discussing it, but what it does show us is that even though the analysis has found a really, really important trough over here, it looks as if it's still expecting the market to move down again in the future. The reason for that, as a matter of interest, is because I have performed a peak analysis on this chart as well. And here you can see the peak analysis. And peak analysis is indicating a really important peak in the GDX. Is it GDX? GDX ETF. And that peak is over here. It's a peak of at least 18-month magnitude, or 14 months, according to this nominal model. And that's why the composite model line is going down. I'd like to say something about applying peak analyses. The feature or function it's a new feature in Sentient Trader. It enables you to perform a dual analysis. So you have a trough analysis at the bottom, which is the traditional Hurst analysis, and then you have a peak analysis at the top of the chart, which performs a separate analysis using peaks. It's a new feature that we're testing. It's not a proven feature, and it's not traditional Hurst analysis at all. It's an interesting feature that I've enjoyed playing with for some time. I find it very useful. Sometimes it really works. Sometimes, I must warn you, it doesn't. Some markets simply do not have good peak analyses. There's no getting away from it. So it's a useful feature, but as with all powerful features, you need to be careful that you're not just using it willy-nilly and just using it because it's there. So what I usually do is I also perform an analysis where I don't perform a peak analysis. And here's the analysis of GDX without the peaks. And that shows us a very different picture. And it shows us here that the very long cycle trough that formed in September was, according to the composite model line, the CML, was expected to be the big trough, and now we're expecting a bit of moving around and so on. And here is the next major trough in the GDX. Interestingly, at exactly the same time as we were looking at for gold, March, April. Okay. Sometimes it's important not to use all of the tools that are available to you. It's it's a bit like pruning an olive tree with a chainsaw, which, as a matter of interest, I was doing last week. But you don't want to throw all your power tools at something, if they're not appropriate. And the same thing is true with this peak analysis feature in Sentient Trader. Sometimes a peak analysis in Sentient Trader isn't any good, and it blurs the picture, and it's not very useful. Sometimes it is very useful, and it should be used. So as all powerful features, you need to use it with caution. So John's saying that would work very well. I agree. I must say, I think March and April next year is going to be a very interesting time for gold, and probably for the gold miners. I'm very interested in trading gold miners. I do trade gold miners fairly often. I trade the gold mines in Africa as a South African. I feel I need to do that. So I trade gold mines in South Africa. So I'm looking for some very interesting entries March, April next year. And I missed something from Vitali. There we go. Can I make a comment about crude oil, my analysis? Okay, we'll take a look at crude in a moment. I want to quickly take a look at the S&P 500 just for a quick wrap-up of that as well. And still like the olive tree minimal. Any market you recommend not using peaks analysis, David? Robin, it's interesting, and I think it shifts over time to the bottom line. So I don't think there are markets. What I've started doing, in fact, I've done it for a long time, because peak analysis has been available in Sentient Trader actually for some time. And what I tend to do as a matter of habit is I create a chart with both, and then I create a chart just with troughs or just with peaks. And I monitor them separately. And they go through phases where they work really well together and they're very powerful. And then they go through phases where one or other of the analyses isn't very useful. I'm afraid I can't give you a simple answer which markets I recommend not using peaks for. I find forex markets generally work very well. And in fact, the double analysis I first created for Sentient Trader and first used it in the forex market, because of course the forex market, which way up is depends on where you're standing. You know, the euro US dollar. If you're European, then you would the euro US dollar chart, this one over here, and because up means that your euro is getting. Have I said that correctly? I think so. So this makes sense to me as somebody in Europe, because a higher price means more money for my euro. But as an American, you're probably more inclined to look at this market the other way around. It would be the US dollar euro symbol, and so the process of a trough analysis in a forex pair is a kind of a debatable. It's a very moot point. Which way is up? It really does depend where you're standing. So the simultaneous trough and peak analysis, in my experience, works very well for forex pairs, and in fact that's why I first created it. As you know, I created Sentient Trader for myself, for my own trading, and I did the double analysis for myself for trading forex, and then I found that it often applies really well to the stock market as well. So I started applying it to stock markets as well. But generally, Robin, in a very long answer to your question, generally I think it works better for forex and less well for stock markets, if that makes sense. And gold and commodities probably work better with peak analysis rather than a dual analysis. And as John pointed out in his webinar, interestingly, gold analyzes really well with peak analysis, but gold miners, because they are stocks in gold mining companies, work really well with trough analysis. So you've got an interesting combination of complications there. What I would like to show you now, one of our regular attendees to the Hurst Trading Room is David at Trading Hurst, and he emailed me this chart over the weekend. Have I got the right scale here? Yes. He emailed me this chart over the weekend, and so I thought I would show it to you and discuss it with you, because he wanted to point something out, a very interesting observation that he made that I thought was really worth sharing. Couldn't be with us to discuss it today, but I'm hoping to get him on the line early next year, and we can start discussing some of the subtleties to this analysis. So I can't really present the entire analysis to you. I just wanted to show you something really quite interesting. When we look at the S&P 500, I hope you're all seeing this chart. You should be seeing this chart. It's a long-term analysis of the daily chart of, I think this is the S&P 500 or perhaps the SPX. And it goes back to 2008 or something like that. And he's using a shorter nominal model that he would probably have to explain to us himself. But he's using a shorter nominal model, as discussed in a webinar that we had a few weeks ago, about a month ago. We had a webinar where I introduced a nominal model presented to me by John, with the 7-year cycle and so on. So he's using that nominal model. Anyway, the point that I really wanted to make is that this white line here is the composite model line. Oops, it's popping up all kinds of right-click menus and so on. Okay, so that white dashed line, that doesn't really help to illustrate anything. I'm on like a different drawing system. Okay, that's really quite confusing. Oh, here we go. Sorry, how do I undo? There we go. Okay, all right. So that white dashed line is the model line, which of course you know now is a result of taking all of the cycle information that the software has and putting it back together again. And you can see using the shorter nominal model, David has produced an analysis that where composite model line really matches the price movement very closely, which in my opinion is an indication of a good analysis. That's not a proven comment. It's just the composite model line is a tool that we're experimenting with in Sentient Trader, but it does seem to be the case that when the composite model line matches price fairly closely, you get you have an increased confidence in your analysis. A few points to be made about this analysis, which is why I wanted to show it to you today. The one is that this second peak that is forming round about now, according to this analysis, you can see is not expected to beat the peak of earlier this year in the composite model line. Okay, I'll give up drawing arrows, I'm not really working. But the peak is not expected to be a higher peak. And of course, as the stock markets reach up towards higher peaks, that's the big question on everybody's lips. Are we going to see another higher peak, or are the markets not going to get up above the level of the peak earlier this year? So the composite model line indicates that we're not expecting a higher peak. That means a foolproof method of forecasting. It's just interesting to observe. But the really interesting observation is that is what's expected to happen as price. Oh wow, that's a skew line. As price comes down to the this pen doesn't work very well on this form of presentation. There we go. As the composite model line comes down to the 54-month cycle trough, or that's an even longer cycle trough, it's a 7-year cycle trough, expected sometime late 2016, 2017. Something very interesting happens, and now this reddish line here is an FLD, and that is the FLD 7-year cycle, I believe I'm correct in saying. So that's the 7-year FLD. That's a really long, really important FLD. And can you see, let me just get rid of this pen, I don't know, there isn't a sort of a clear button. Oh, perhaps that's, no, that's not it. Okay, there we go. Let's get rid of that pen. It really didn't work. But the point I really wanted to highlight is this very interesting thing that's happening here, which is that the composite model line is coming right down to that 7-year FLD. Isn't that an interesting thing? And you know, when you see things happen like that in your analysis, and you see projections coming down to the level of an FLD perhaps, and I've spoken already today about how important FLDs are. When you see a projection coming down to the level of an FLD and bouncing up again, just it's what I would call a beautiful picture. You know, it's a really, really beautiful picture in my opinion. And I've also got here a close-up detail of that, and here you can see the close-up detail. Look at that composite model line coming down and touching that 7-year FLD at the time that the 7-year cycle trough is expected to form, according to this analysis, which is at the end of 2016, early 2017, and then price is expected to bounce up. So a very interesting possibility, which brings me to the final thing that I would like to look at. Or perhaps I'll try and squeeze in crude oil, but I just wanted to quickly speak about the S&P 500. And I don't think there's very much really to say about the S&P 500. Let me just go to the correct website, the correct workspace here, and here we go. And I see a question from Elizabeth asking Sid, and from this composite model, it actually looks like it was only a primary third wave that topped. Elliott wave. Good, so that's an Elliott wave question for Sid. Let's take a look while he's dealing with that. Let's take a look at the S&P 500. So this is one of the indices I've discussed in the previous webinars. And here you can see I'm working both a peak and a trough analysis, which is not really a foolproof approach, but you can see it indicates what we are expecting. Let me not actually zoom in just at the moment. I don't need to spend long speaking about this because we've spoken about it many times before. We had our first peak earlier this year. I think that was May this year. So there's our first peak. Price came down, is bouncing up again to another peak. According to the composite model line, which is by no means the ultimate forecasting tool, but it's an interesting tool to indicate what we should expect. You see, we're expecting price to form a slightly lower peak in this case, and then it's going to gradually decline into early 2017. And of course, in last week's webinar, we spent a good deal of time speaking about this analysis, or a similar analysis presented by Sid. And so you can see that's really what we're expecting out of the S&P 500. It's going to be very interesting to see whether price does succeed in forming a new high at this point, or whether it doesn't. And let me take a look at this chart, see if we get no, that's a completely different analysis. Let me not get distracted. So quickly take a look at crude. Vito, I think it was Vito, Vitali asked whether I can take a look at crude. So here is my take on what's happening in crude. Although crude is a little tricky at the moment. Let's see if this is the right one. Yes. So let's just take a step back, and there we go. And let's put on these semicircles. There we go. So this is one of the analyses that I'm looking at in crude, which has, of course, a very major trough here in early 2009. And this analysis, we had a 54-month cycle trough in early 2014. And then the big question is, what's happened since then? And so you can see, according to this analysis, and I'm by no means convinced it's definitely the correct one, the one possibility is that we had a major trough forming over here. And the possibility I'm looking at here is that an 18-month cycle trough formed at the end of August. I didn't prepare to speak about crude, so I won't go into too much detail about this. But the one important point I'd really like to know about analyzing using Hurst cycles is this. It's that even when you get the absolute magnitude of a trough wrong, generally, as long as that magnitude is several degrees greater than the magnitude that you are actually trading, generally, you're not going to go very wrong. So we could have a big argument, and in fact, well, let's not have a big argument, but let's just zoom and take a look at recent troughs in crude. And you can see there was a trough here in March, which according to this analysis was a 20-week cycle trough. And there was another big trough in August, which according to this analysis was an 18-month cycle trough. Now, my point is that other analysts will often come to me and say, no, I don't think this was an 18-month cycle trough. I think that March was the 18th cycle trough, which means that this was only 20-week. But the point really about this is that even if you get your analysis wrong, generally you still have the correct. I see Stefan saying the crude chart's 2 months old. That's right. This is an old. I'm sorry about that. I haven't updated the crude analysis. But let me just finish that train of thought. My point is that even if you get the magnitude of the trough wrong, generally you're getting the basic rhythm of the market right. So at the which I'm particularly interested in trading, which is getting in and out for a few weeks perhaps. So you're looking at the 20-day FLD, perhaps the 40-day FLD. Then even if you're getting the magnitude of an 18-month cycle trough wrong, and it should only be 40 weeks, or perhaps it should only be 20 weeks, and you are generally trading with the correct rhythm for your time frame. Yes, you're right, Stefan. I need to update the data on this chart. I'm sorry about that. So that was a real waste of time. Sorry about that, really. Those are not updated charts, so we not seeing what's happening with crude. Where's crude at the moment? About 41, I think, or something like that. So I don't think this analysis will be greatly invalidated, but it isn't an up-to-date analysis. Okay, there we go. That's really all we have time to speak about today. I see John saying an important and tradable low is due in the coming weeks. Should keep track of the market regularly. That's for crude oil, I presume. So an important and tradable low coming up in the coming weeks, so we should keep track of it. And that is indeed what we will do. Now, today is unfortunately the last webinar of this year, of 2015, because we're entering into the holiday season. And so we're not going to be able to do another webinar into the end of the year, but I will be back in January. I've really enjoyed doing these webinars with all of you this year. Thank you so much for it. Thank you for coming along and being here and keeping the conversation about Hurst cycles going. I wish you all a wonderful Christmas, a good festive season, and I look forward to seeing you all in the new year. Stay safe over the festive season, and have a wonderful time and profitable trading, of course. Generally, it's not a good idea to trade too much around Christmas and New Year because it can be a little unreliable. So be careful out there and have a good festive season. Thank you very much, and I look forward to seeing you in the new year.